In this week's video, we'll review the latest charts and data to help us answer the question, are stocks setting up for a painful correction? To help us assess the probability of good things happening relative to the probability of bad things happening, we'll be focusing on 4 major data sets. The video is designed so you can use the pause button on your video player. We'll be moving very quickly because we have a lot of material to cover. In last week's video, we covered a rare signal on the S&P 500 yield chart that previously had been seen in 1975, 82, and 2009, years that saw the S&P 500 make a sustainable major low. In this week's video, we'll be looking at the latest data and asking, does that data start to question this type of outcome? Data set number 1, sentiment. Tweet dated August 13th, Michael Santoli points out that the National Association of Active Investment Managers equity exposure currently above 100% long. How can that be? They can use leverage. Now, it's hard to make an argument that that's not an all-in data set. Thus, it's fair to ask, how concerning for the stock market? Here is the data set referred to in the previous tweet. Chart dated August 14th of 2020. Current reading 101.2. So what we've seen in the rear view mirror down here near the March 23rd low, this is a high degree of professional fear. These are professional money managers. And they've taken their equity exposure down near the 10% range, which, as you can see, is extremely rare. It's also extremely rare to move from the lower blue line to the upper blue line. In fact, it's only occurred 2 previous times. What we're looking for is something similar to the present day. This is a de facto sentiment gauge. Why? If you only have 10% equity exposure down here, you must be bearish. So since it's a sentiment gauge, a similar move would be going from an extremely high level of professional fear to an extremely high level of professional confidence about future economic outcomes. So we're looking for the first move into this area after being down here. It's only happened 2 previous times. Near the major low in 2011, hit the similar reading to the present day on February 1st, 2013. We had an extremely low reading in this area here in the 14, 15, 16 area, weakness in the equity markets. And then the first time we're able to make it back to the present day reading is July 29th of 2016. Low to high, low to high, low to high. The 2 previous times that we saw a similar reading, July 29th, February 1st, similar to the reading that we have this week on August 14th, might be helpful to ask and answer. How did stocks perform walking forward after similar shifts in professional equity exposure? Asked in another form, was the end of the rally near? In both cases, the answer was no. This is February 1st, 2013. And this is July 29th, 2016. Similar readings to the present day on August 14th. In both cases, stocks had moved a long way off of the low, moved a long way off of the low, and after we hit the similar high exposure reading, in this case, the S&P 500 tacked on an additional 40.82%. In this case, the additional gain 32.17% into the peak in early 2018. There's no question this is a high reading, and thus, at face value, it is concerning. So it's also important to understand what maximum drawdowns look like between point A and point B. In the 2 previous historical cases, February 1st, 2013, the maximum drawdown in the S&P 500 looking out 1 year was 1.67% from the date of the signal. And in the July 29, 2016 case, the maximum drawdown looking out 1 year in the S&P 500 was 4.07%. If we saw similar drawdowns in the present day, wouldn't be shocking to see the S&P 500 backtrack to this blue line here above 3,300 or all the way back to the red line above 3,225. Thus, even if good things happen on a longer time frame, it's extremely important to have realistic expectations about 100% to be expected in normal volatility that occurs within the context of all trends. So to go back to the original question, how concerning? Well, it tells us it wouldn't be shocking in the short run to see a drawdown, but historically, the rally was far from over in the two previous cases. So it is fair to say on February 1st, 2013, July 29th, 2016, and August 14th, 2020, that professional managers are all in. These are very high readings. But in those cases, all in didn't mean the rally was about to end. How is it possible for the stock market to continue rallying? Well, one possible answer to that question relates to individual investors. In the present day, individual investor sentiment, bearish sentiment, is still 38% above the historical average. An individual investor bullish sentiment is still 21% below average. Both of these figures speak to cash on the sidelines. 42% of individual investors are bearish in the present day versus the historical average of 30.5%. How does this figure here, well above average, compare to this figure at point A in 2013 and point A in 2016? Better, worse, or about the same? In terms of potential fuel, individual investor skepticism is much higher today than it was in those two cases. We're at 42.1% bears, present reading. February 1st, 2013, only 24% responded bearish. July 29, 2016, only 28% said they were bearish. So if anything, you can make an argument that the setup in the present day is better than the setup here and the setup here. As we review the three remaining data sets, we once again want to ask ourselves, do these data sets align with or contradict all of the bullish evidence that we've been covering since April 6th? Data set 2, momentum. We reviewed this topic from a different perspective last week. Last week we were on a monthly chart and we were using monthly MACD. This week we're using a weekly chart and using full stochastics. There's a plunge in the S&P 500. Stochastic drops below 16.5. We've made it all the way back. We have a weekly close last week above 95. This move from here to here in the stock market and this move from here to here in this measure of momentum aligns with this concept that we've been talking about for months. Therefore, it might be helpful to ask and answer, how many times has something similar happened over the past 40 years? The answer is 15 times. What happened walking forward in the stock market? For the most part, good things happened. 2 years from the date of this signal, which would be similar to the signal that we received on August 10th of 2020, all 15 cases the stock market was higher. Worst case scenario, higher by 4%. Best case scenario, higher by almost 54%. Average gain, 26% in the S&P 500. Median gain, just a hair under 24%. Telling us to try to maintain a longer-term focus as long as the data allows, even during 100% normal and to be expected volatility. Notice the average and median gains over the next 3 months. The market really doesn't make a lot of progress in the average and median case. And 3 months later, 40% of the cases, the market was lower, not by a wide margin, but lower. Thus, if we hope to capture these returns, hypothetically 2 years out, in the historical cases, you had to withstand volatility. You can't get to the right side of the table by over-trading on the left side of the table. Thus, if we're going to embrace the 2-year column here, we have to understand the maximum drawdown in each case as well. If we put the historical drawdowns, looking out 6 months, onto a present-day chart, it tells us the S&P 500 could drop all the way back near 3150, and we still would be in the bounds of the historical study and this table. To capture this, investors had to endure this. The average drawdown was 2.69%, median 2.6%. The maximum drawdown was 6.16%, which hypothetically would be this level here. Data set 3, basic materials. It's our rate of change concept, which means we should be leveraging these concepts. What can we learn when there's buying conviction in basic materials? Basic materials index here, where my cursor is. This is rate of change. After the low in 2009, this big spike in the rate of change represents a rare shift in the net aggregate opinion of all market participants regarding all subjects on all time frames. We have data going back to the year 2000. The only other time that we've moved from the thick blue line to the thin blue line, present day, we saw a similar rare shift in that net aggregate opinion. It is the net aggregate opinion that moves markets, not our personal opinions. Since it's only happened 2 times in the last 20 years, it might be helpful to ask and answer, how did the stock market perform walking forward from the previous case, or July 23rd of 2009? Here's July 23rd, 2009. This is the S&P 500. The answer is quite well. We rallied into the spring of 2010, and the S&P 500 tacked on an additional 24.68%. Once again, to capture the move from point A to point B, there were significant drawdowns along the way. 3.2%, 3.5, 4.3, 5.6, and 8.13 to capture the 24.68. Even if good things happen in the present day, we should really expect volatility to pick up walking forward. Data set number 4, transportation stocks. Economically sensitive transportation stocks. Similar situation here, 100 trading day rate of change. It's been 100 trading days since the S&P 500 low on March 23rd of 2020. Only seen a move like this 3 times in the last 40 years. August 10th of 2020, we hit the green line. July 28th of 2009, we hit the green line. And December 27th of 1982, we hit the green line. This represents the past actions of some market participants. So does this, and so does this rare move here. How did stocks perform walking forward from this date and this date? Notice the market had already rallied a long way to get to this date. Huge rally here to get to this date. And walking forward, in the first case, really good things happened for a very long period of time. In the second case, really good things happen for a long period of time. Simply telling us to keep an open mind about much better than expected longer-term outcomes. Does not represent a prediction in any shape, form, or fashion. We do not trade historical studies. We trade the chart in front of us. The studies simply help us with potential upside relative to potential downside. The maximum drawdown in the 2 previous cases, if we put it on a 2020 chart, we could fall to 33.45 or 32.69. Historically, if you wanted to capture some of this in here or some of this in here, you had to sit tight when something like this or this occurred. Is it realistic to believe that the S&P 500 could move double digits over the next 2 years? We covered a data set from LPL last week that said yes, it's possible. This week, they presented the largest 100 trading day rallies in the S&P 500. Was that the end? No. In every single case, except for one case, the S&P 500 was higher 12 months later. That's after the 100-day gain. Average gain, 9.4%. Median gain, 9.4%. 1 year later, 94.4% of the cases, the S&P 500 was higher. The concepts here align with the concepts here and the historical results here. And once again, you could focus on the 94% chance of gaining roughly 10% in the next 12 months and totally ignore the message in here that tells us it could be difficult over the next 6 months. Look at the average and median gain in the S&P 500 down here, relatively muted. To get over here, you had to withstand all of this in here. So back to the original question, are stocks setting up for a painful correction? Well, that all depends what your definition of painful would be in the stock market. In the real world, a 6% correction is pretty painful. In the 1991 case, really, from the date of the signal, no pain, no drawdown. So it's probably fair to say the probability of a pullback unquestionably has increased in recent weeks. But there are historical cases where there was very little pullback from current levels. The pullbacks happened from higher levels, helping us keep an open mind about a wide range of outcomes. For clients, it may be helpful for us to ask and answer at this point, how are we doing relative to all this? April 6th basically said we should keep an open mind. Market's doing things that really doesn't fit in with the bearish case. May 8th, we said we had a lot of data in hand that says the low may be in. To get an idea of where we stand, let's look at some charts that can quickly summarize the concept of trading the chart in front of us. Trading the chart in front of us means paying attention to present day data, the charts that we have today on multiple time frames, the data sets that we have today on multiple time frames. And that's what the market model does. The market model tracks all of that for us. You can spend a lot of time thinking about what was, and you can spend a lot of time thinking of what could be or might be. That is radically different from thinking about what is. On May 14th of 2020, this is what is looked like. This was the chart in front of us. And we acknowledged at that time in a weekly video that this chart had work to do. But we said it wasn't that concerning because 52 days after the low in these historical cases, the charts also had work to do. And back in May, we basically said we can use these as roadmaps. We want this chart with blue, the fastest moving average on the bottom, and price for the most part below the moving averages. And the moving averages were either downward sloping or flattish at that time. We said if good things were to happen for a long period of time, at least from a probability perspective, the look of this chart here, which is similar to the look of the chart in here, needed to morph into something more like this, or this. How is this different from this? Over here, blue, the fastest moving average is on top. Here it's on the bottom. Here the slope is up. Here the slope is down. Here price is below most of the moving averages. Here it's above. And why was that relevant on May 14th? Because we have to move from a look like this to a look like this if we're expecting good things to happen for a long period of time. which is exactly what happened in each of these historical cases. Now it's August of 2020. How does the chart in front of us look today? How does what is look today? Not what was or what might be or what could be. If we're on track, what is better look a lot more like this, a lot more like this, and a lot more like this, and a lot less like this. And that's exactly what we have during the trading session on August 14th of 2020. Contrast the look of this chart on May 14th, the chart that had work to do, with the chart in the present day. Now, blue, the fastest moving averages on top, prices above all of the moving averages, and the moving averages are tending to trend up from a slope perspective. From a probability perspective, this is what a sustainable uptrend looks like. And notice, a sustainable uptrend does not mean no volatility. Plenty of volatility and givebacks in here. Plenty of volatility and givebacks in here. And plenty of volatility and givebacks in here. But in each one of these historical cases, the uptrend continued, in this case, for several years. Is it possible that all of the data that we should be concerned about in the present day, and there are things to be concerned about, will eventually cause the market to reverse? Yes, it's possible, but it hasn't happened yet. That's what might be, or what could be. That's a forecast. This is what is. Are there things to be concerned about in mid-August of 2020? Absolutely, positively, yes. And if the list of concerns turns out to be a legitimate list of concerns, guess what? This chart will not be making a series of higher highs and higher lows. If you trade the chart in front of you, we can handle a wide range of outcomes, from wildly bullish to wildly bearish. But the only way that we can do that is to head into next week and every week with a flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.